right, stock started the holiday week with its lowest volume session in the past 3 months. You have to go all the way back to the end of the summer when people were still on vacations and no one was around. It was a very, very light volume day, a very small range. Volatility dropped to low levels. The volatility of volatility dropped to low levels. And it seems like pretty much everybody took off for Thanksgiving already. Aside from energy markets, we're going to take a look at, there were some moves today that were a little bit abnormal, as well as some interesting patterns in the market forecast chart that would suggest what may happen actually over the next couple of days, potentially even Friday. Friday has not been the nice and quiet half day of trading. You know, last year or even like, for example, back in 2018, I told you before, in the years that we've been bearish, the fourth quarter tends to be bearish, and this week here, coming out of November expiration, when we've already been so bullish this quarter, would suggest that this might not be the case. The pattern we got today might not be the case for the rest of the week. So I'm going to show you what I think is going to happen and why, what's driving this market today, and then our trade idea is a stock that has been a little bit more volatile than the market. So we'll look at a trade idea on that and talk about how to do that. So let's go ahead and get started. Today is Monday, November the 21st, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here in the bottom right corner of your screen. Also hit that red subscribe button that's down there. Hit the thumbs up icon to like our video today. Comment on anything that stood out to you. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video, our upcoming classes. Come down here, click on this heart. It opens up this tab. Hit that like button. Same thing with this thumbs up icon. Opens up this tab. Hit that like button. The more you do that, it helps get our content out to more of our followers there. Our goals are to get over 100 likes on the tweets, and right now, at least 25 likes here on Facebook posts. I also wanted to bring up, we do have our Black Friday sale coming up at the end of the week. John, we really appreciate it. I wanted to kind of note what John says here. He alluded to the Black Friday opportunity coming up, and a little bit of an endorsement there. We really appreciate that. Thank you very much, John. I've said this before. If you look at how often we do these Market Outlook videos, we do about one a day for a business day for 3 years, for an example. Our premium subscription, as you can see here, is for 3 years, and this price is actually going up to $34.99 to reflect inflation over the last 5 years. It's been the same price for the last 5 years, but that's going to go up at the end of the year, going into next year. So you get the Black Friday sale is actually a 20% discount on this rate, so you get to be able to take advantage of that. Now consider, that rate here it ends up being $23.76 is 20% off of our premium subscription rate. If you look at, we do 750 videos over the course of 3 years. That's like hitting this thanks button and donating $3 to show your support for our channel. Donating $3 for every $3.20 for every Market Outlook video for the next 3 years. But which I would hope these videos are worth something to you all as we do them day in and day out. But in addition to that, you would get not only showing the support for the channel, but you would also be getting all of this in addition. And again, at a rate that's actually far less than what it's going to be going up to, about almost 2/3 cheaper than what the rate's going to be. So about a 33% discount from the upcoming up-to-date rate with our Black Friday sale for just a few bucks a Market Outlook video, in addition to everything else on this list here that you end up getting with that over the course of those same 3 years. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. We ended up with a really small range today. well less than half, easily less than half the average. A very inside, almost a completely inside day. You'll see in a minute extremely low volume. The near term line did form a bullish low point. As of right now, it's in bullish territory. Not quite in the upper reversal zone yet, but it's at least in bullish territory. The momentum line did drop, so that doesn't necessarily portend good things. You can see usually when the near term line's gotten into bullish territory, the red line preceded it, right? The red line gets up there first. The red line did not get up there this time and is already back down in bearish territory. So you would expect that the near term would follow suit, as it's a little bit shorter of a time frame or longer of a time frame than the momentum line is. So that suggests that we might end up getting a pretty bearish near term peak here. Obviously, it would be a lower high point, and it would be a peak that's not above 80. So keep that in mind. The intermediate line is easily above in the upper reversal zone. So the posture is still strongly bullish. We're still easily more than 2.5% above. So the posture is still, I mean, even the moving average is almost above those lines, which again is going to really strengthen that support on the way back down. If we come back down, it's going to really strengthen that support level there. And would, obviously it would be a pretty significant break if it did break that. But until it did, you would expect that it would hold until it broke, right? So it'd be a pretty strong support level on the way back down towards 3,800 again, if we end up getting into that spot. Looking at the different indexes, we'll look at the Dow first. It's the strongest one, still more than 5% above 30-day moving average. Near-term line got a little bit higher. We're more flat than the S&P has been over the last little bit. We're still hugging that 62% retracement line of the year-to-date decline. This is the long-term market sentiment decline. Market sentiment's actually come back out of bearish territory again. It did it over here too, so it's not out of the ordinary. But again, like I was saying before, the momentum line dipped here without getting. So last time we had that, where the near-term line got up there without the momentum line, we kind of had that dip, and then the momentum line, bounced back up, and the near-term line went up with it. But you can kind of see the kind of loss you can get when the momentum line does not get up into the upper reversal zone and the near-term line does. It kind of leads to some weakness. Again, you kind of saw it over here too. Momentum line didn't get up there, the near-term line did, and you can see the weakness. So this is the kind of weakness based on these kind of rallies, these other moves, that's the kind of weakness that you would expect to see tomorrow, Wednesday, before the Thanksgiving holiday. Again, assuming that there's any kind of movement. It seems like there's just really no movement at all in the markets. Let's look at the NDX. That's the weakest one here. You can see its near-term line didn't even get close to the upper reversal. Didn't even get in the bullish. Didn't even get in the upper half of the chart. So it's already back in bearish territory where the momentum line dipped back down to. So it's kind of following that line down. Remember the Dow is up the Dow is way up here. It's on that 62% retracement. So the Dow is way up here, relatively speaking, right? It's at the 62% retracement of its year-to-date rally. The Nasdaq's way down below the 23% retracement, and now back down below the 38% retracement of this intermediate decline that we've been retracing here. So you can see how just a lot more bearish the Nasdaq 100 is, and then finally the Russell 2000. Again, the Nasdaq's up here at the 62% retracement line. The Russell's way down here at the 23% line. And then you can see the 38's right there. So it's a little bit more bullish, just a little bit more bullish than what the Nasdaq. But again, its near-term line didn't get in the bullish territory either, and it's more bearish now. No jump in the momentum line that would precede the near-term line rising. So that would be the first sign that you'd get. And considering it's still in the lower reversal zone, you would actually expect the near-term line to come back down here in the next day or two into the reversal zone as well. Let's take a look at the weekly chart. You can see we're getting a lower close. So again, week's not over with. It's going to be a short week. It's only going to be a 3.5 day week. But we are getting a smaller candle. We are getting a lower close. Now just a matter of, do we close below this week's body next week? That would be the important sign. Remember, that's the important thing to consider this week with the bear tag that I showed you before a couple weeks ago right there. If we were to kind of get this kind of candle again, similar to what we got over here and similar to what we got over here. When it wasn't quite a bear tag, but similar idea. If we were to get that kind of candle back down, if we were to close towards 3,800 by the end of the week, even on a holiday week, then you can kind of see how bearish that would be, and obviously it would lead to bearishness on that Hakinyashi candle. We would be set up for a close below that body for the next week, and potentially, I mean, the moving average at 38.77, you'd have your red arrow again, which would be bearish. Your PPO is still rising, it's still negative, but it's rising. So technically, you have everything. You just don't have a bullish candle. You don't have a higher close here for the week. So it's the one thing you're missing to be bullish. So starting to show some pockets of weakness. You don't have a red arrow yet, but you do on the Dow. And it's crazy because that's been the most bullish, but now it's the only one that has a red arrow. The Russell also has the red arrows. The Nasdaq's actually the one that's furthest away, and that's been the weakest one. But you can see they're all pretty much starting to show weakness. The S&P is still up against this point of control and these Fibonacci lines, still above its 8-day moving average. The Qs are below its 8-day moving average. The MACD is rolling over. The stochastics are already below its moving average down there. The Russell 2000 is below its 8-day moving average. MACD is below. Now let's look at the IWM, and you can see it's also below its 8-day moving average. The MACD is below its moving average. Stochastics is down there. You can see when I look at the stochastic chart here. Oh, excuse me. Let's look at this one. I got it on this grid. You can see the significance. We are below, like, the moving average, the actual stochastics of where we're closing relative to the 4-week range is below its moving average. So it's been below it a few times. It's already been below it once here and again here. But remember, we're expecting these kind of drops, this kind of drop, this kind of drop, because of the momentum line following, the near-term line following where the momentum line went over the next couple of days, with the stochastic already below its moving average. So you can kind of see the weakness that's developing there. Remember, the Arun indicator, also something that we look at. Once that green line falls below 70, we're susceptible to the jump in the 4-week range to a new 4-week low point. Now keep in mind, when I look at the 4-week range, like, we're nowhere near a 4-week low right now. We're nowhere near even filling in this gap. But if we were to break down below last week's low point, you can see how, if we were to start to fill in this gap, how, that's an easy range to fill in. I would actually expect us to fill in that gap sooner rather than later. Now this low is not going to move anytime soon, so that's going to be the low point for the next week. So that's going to have to get back to zero before, and then again, this is really close to getting below 70. So once we get that Arun below 70, the green, which is the 4-week high point, once it gets below 70, and this gets back to zero, now we're set up for the spike in the Arun. In this case, would be the red line from 0 up to 100. The other thing we've been looking at here lately is that McClellan oscillator. It's still really low levels, so it oscillates up and down, and we're below that 35 level, which keeps us trending. So we're back to really, and we're not negative, so it hasn't gone negative yet. We are slightly positive on summation. So it's really important that we kind of hold this trend line, however we end up drawing that trend line. This has been drawn there for a while, but this best fit trend line, it's really important that we don't go negative here. And that summation stays positive. Otherwise, another indication, along with, remember, the on-balance volume, with this tremendous divergence we have on the on-balance volume, also indicating potential weakness. And remember, you can kind of see where the volume is. That's as low as we need to get below there to confirm, and we're not very far up above it right now. That's the problem, right? Is like, here's this peak that we still haven't gotten above, even though price is well above that area. Still, we're not above that point. So we're, that's one of the reasons why we haven't been that bullish during this rally, is because of this weakness that we're seeing. The RSI and the CCI are not in bearish levels, are still down here. You can see they're still showing weakness. At least we are in the upper half of the chart. We are in the upper half of the CCI too. So we're not necessarily strongly bullish, but at least, so far we're still in above these midpoints instead of below them. We were briefly below them there, and it didn't quite hold. You look at your DMI. We are still above 25 in the positive indicator, even if the negative is, moving up a little bit there. It's actually still below 20. So you still have, you're not too strongly bullish there, but I mean, at least you're still bullish. You're still above the cloud. You're still above the green line. The green line's still above the blue line. You still have an intermediate trend strength going on. So as sideways as we've been, and as really not very bullish as we've been, we also haven't been too bearish, right? We're still in the upper half of the range. Even if we're not in the upper quartile, we're at least in the upper half of the range here. The Bollinger Bands are still outside of their Keltner channel, so that we're losing momentum. So they're not extending outside of it, but we're still, we're not out above the Keltners. We only did kind of get above it that one day right there. But now we're back into it. So, so we're not really showing a lot of strength of momentum, unfortunately, right now on the Keltner or the Bollinger Band. So kind of a common theme that we're seeing here. We're pretty bullish, but we're not very, we're bullish, but we're not strongly bullish. We're not bullish enough to be trending, but we're not bearish either yet, right? Even though, again, the momentum line suggests that the near-term line will come down that low, and of course that would lead us to more of a decline that we saw over here the last couple of times. These kind of declines where the near-term line got up too high, that the near-term line got up higher than where the momentum line got to. I cannot talk tonight. And then you can see the declines where the near-term line recovered back to where the momentum line typically leads it. You can see, look at the volume. This is the lightest volume that we've had since way over here in August, the end of August. This is a really, really low volume day, typically almost half the average. Very, very 51 million shares, 3 points, so below the midpoint of the ATR. So 51 million shares trading, 3 points trading. You can see the ATR has dropped down to less than 2%. 1% is the bullish trending mark. So we're still high. We're still actually higher than we were over here in August when we were pretty strongly bullish over there as well. So, and the volume is actually still higher now than it was over there too. Remember the on balance volume. We're still, but the moves we saw today, 51 million is way down here. 3 points is way. They're both so extreme. They're below the charts, and that's considering that the VIX is compressing. The VIX came really low. It's down to one of its lowest levels. The VVIX is really, really low too. Again, it's down to a new 52-week low again this year, or this week so far. So, we're really compressing in a lot of areas, and that typically leads to an expansion. And considering the resistance, you would expect the expansion to be in the downward direction. All right, now let's take a look at what's driving this price action today. You can see kind of everything is converging here over the last few weeks to the point where we're getting 3-month returns that are pretty flat for international stocks, at least developed market stocks. They're now break even for the last 3 months. The dollar, which had been bullish, is now break even for the last 3 months. Commodity prices had been break even. They're down a little bit the last couple days. You can see everything else is starting to gradually move up to the upside. Your Qs are still down quite a bit. Bonds are still down quite a bit, which means yields are higher, and real estate is still down quite a bit. It's interesting. There was a time where those were your 3 safe haven areas, if you remember correctly, for a good chunk of last year. And whenever there was any kind of volatility, those are the 3 areas that tended to hold up. And now they're kind of showing some weakness here. If you take a look at just how things performed here today alone, so let's go to an intraday chart. And you can see today the dollar was your big mover to the upside, and that generally puts pressure on equities. In fact, it put most pressure on emerging markets. They were down 1.25%. Commodity prices were down until a late little jump in commodity prices brought it up to more in line with where U.S. equities finished. But they were down there, again, all mainly from the strength in the dollar. Yields were down. You can see long-term bonds finished up here, and then you can also see that real estate finished up. So what's been not working in terms of at least real estate and bonds rallied. Qs did not. They were down 1%. Again, most of it because of the pressure that you can see coming from the renewed strength in the U.S. dollar, right? A little bit of a bounce up, back above this 38% retracement of that rally we've had for most of the year, back above the 8-day moving average. MACD is turning higher, stochastics is turning higher. You can see how things are looking more bullish for the dollar, and it looks like bonds are kind of hanging out here and stalling so far at the 50-day moving average. So it's not quite getting the nice strength, the renewal of strength all the way up to 115 yet to really fill in that gap between the 50 and the 200-day moving average. That would put some pressure on yields. Problem is, it's going to be hard for yields to break this like 365 level, which would be the 23% retracement of, again, the year-to-date rally. It'd be hard to break that if the Fed's not cutting rates, especially when the Fed's expected to actually raise rates up to 5% by the not this coming Fed meeting in December, mid-December, but in February. So it's going to be hard to break that level, and more than likely you're going to end up kind of stalling here and then bouncing back up. And again, the strength in the dollar and the strength in the yields has been a recipe for volatility in the markets. Commodity prices, have been kind of fluctuating and really building up a big volume node right here, right around 25 to 25.50, maybe up to 26, where the 200-day moving average is right now. We broke down on Friday below the 50-day. We've stayed below the 50-day and below the point of control. So it's relatively bearish from that perspective. And keep in mind, if things do get more bearish on commodities, that's a big gap to fill in here. If we were to break down below this 25 level, a really significant gap. We're already below the 8 and 17 last week after getting back above it 2 weeks ago. So you can see that, this, again, breaking down and filling in this gap would be a reflection of significant drop in demand or demand destruction. Anytime commodities have filled in that gap, it's generally been associated with some kind of global slowdown or U.S. slowdown or both. So keep that in mind as commodities are trying to figure out. Whereas, on the other hand, if we rise back up above these moving averages, then now we have a renewal of inflation expectations, because those are, pretty much closely tied to how commodity prices are performing, at least the expectation part of it. So if we take a look at how the sectors performed here today, you can see, over the last 3 months, again, we're kind of getting back to zero on some of these reopening trade type sectors, industrials, financials, energy, materials, these cyclical areas, but are not XOK, XLY, XLC. They continue to be the weaker areas, again, over the last 3 months at least. If you look at how things performed here today alone, so let's come over here to 2 minutes. Again, you can see staples, real estate, utilities are your bigger performers. Financials, industrials, materials are kind of hanging out there. Healthcare doing well. Again, safe haven mixed in with some of that reopen trade. But on the other hand, energy, again, until that midday jump in crude oil, energy was down 4.5%. Energy stocks were still finished down 1.5%. So still a significant drop to the downside. You can see the crude oil move, big, long, lower shadow. So keep in mind, that's a really bullish pattern when you get a long lower shadow, especially near the bottom of the value area. Yes, we are below the 62% retracement. We tried to get below the 78. We already failed there once. We got there again. Two long lower shadows in a row. It'll be interesting to see if that leads to some bullishness, because that's a really bullish pattern. We can trade in the range, but that low point of that long lower shadow can be a support. So really important to watch that going into the end of this week. Again, 2 more days, a day off, half day on Friday, which typically is not very volatile, but has been recently in the last so many years. There's been a couple instances of some volatility the day after Thanksgiving. So really important to watch that. Again, rising commodities, rising yields, rising dollars. Typically, it's not typical for the dollar and commodities to rise, but that's been the case for most of the year. that's been the recipe for weakness in equities, and we'll see if that recipe starts to mix back in together again here after kind of not working so much together over the last little bit. Let me show the major markets. Sometimes I'll show you this chart here. Obviously you have China. These are kind of ranked by economies, and you can see dark green shading and a green line all across the board, taking out Russia, of course, except for Brazil. Brazil's the only one. It's got dark pink shading and a red line right now. The intermediate line's in the lower reversal zone. Intermediate line's above 80 or 90 everywhere else. Really high in Europe, Germany, Italy, France, UK, all doing very, very well. The developed markets. Japan, also associated with developed markets, all doing very well. But so is Korea, so is China. So until you start to see some weakness in some of these areas, at least light pink shading and then a light pink shading yellow line. Again, you can just see, like right now, really, U.S. is kind of like the least bullish. U.S. and China are the ones that are kind of closest to its moving average. China being probably the least bullish, as it's barely turned. Barely now has a green line there. All right, let's take a look at our trade idea for today, and you can see I wanted to take a look at Roku. Roku has been dropping a little bit more than the S&P as a whole. Remember, the Dow's kind of flat over the last week or so, but Roku's been dropping. The short-term sentiment's down. Intermediate line's coming down a little bit more. We're just finished at about 1/3% above. We were down below for a good chunk of the day until right at the very end of the day. We were just slightly below that moving average. If you take a look at its 3 green arrow chart, obviously it doesn't have 3 green arrows anymore. It actually has, and it didn't have 3 green arrows for very long. About a week or so before finally getting a red arrow again on the stochastics, and almost another red arrow on the moving average, of course, just 1/3% below that. If you take a look at its moving averages, you can see we actually crossed below the 17 and nearly below the 30 on the same day. Being at the bottom end of the range, right? There's a little bit of a volume node here. You're below. You failed at the 50-day moving average, rolled over. Stochastics already dropping below its moving average. MACD is dropping below its moving average. So you can see some weakness developing. At the very least, you don't have the bullishness anymore. The DMI jumped up above 25 as the positive drop below 25. You take a look at its RSI and its CCI. They're both back into the lower halves of their charts, just barely, but they're both back into the lower halves of their charts there. Looking at the trend strength indicators, you can see we're still below the cloud, and you had a bearish trend, no bullish trend. In fact, you almost got a weak bearish trend developing again already. And then looking at the Bollinger Bands, we are back into the lower half of the bandwidth where that tends to be more bearish. So in other words, back below that line that's in the middle. You can't really see it as well because of let's do the log scale. You can see a little bit better. So back into the lower half of the chart there, lower half or below that green line, which you can see tends to get below that when you're in a bearish mode. Of course, it's depending upon whether or not you're getting the lower quartile or not. You are getting a falling bandwidth, so we're not as bearish, at least not as bearish yet. If you take a look at kind of like potential, like what the long-term view looks like on this, you can see like this stock has been in a bearish trend for a while. You can see it's way below its 200-week moving average. So it's pretty much in a bear market, right? The 50-day is below the 200-day. The stock itself had gotten above its 8-week, but already back down. Last week back below it and holding even further below it so far this week. So you can kind of see it's on a pretty steady trend. It's not dropping too far because the MACD is above its moving average. Stochastics is also above its moving average, even if it is in bearish territory, but it's still a really, really bearish trend. I mean, you look at the long-term trend right now for the stock. We saw the market forecast, but here's what the long-term trend. The short-term sentiment got up, just like it's done here before, and now you can see, as I said before, the near-term line tends to follow the momentum line, and as of right now, the momentum line is dropping into to pretty low levels. You would expect the near-term line will eventually drop to those low levels too if it ends up following the same pattern. So what I ended up doing on the trade was coming over here and doing a long put vertical spread. So going out to the mid, what was at the time when we did the Market Outlook Live today, the mid 30 deltas, buying that put, going out to the $42 wide to do the 2 strikes, still in December. You can see this is what the trade setup looks like. Position sizing for normal position size on the directional trade, so about half my normal position size for my short premium trades, and then getting about 2 times the reward for that risk. And considering the probabilities here, very unlikely we would lose all $500. So probably, if this thing continues to move higher, we can cut the loss at $100, $150, $200. Even at $200, you're looking at about a 4.5 to 1 reward to risk ratio, which makes this kind of a trade well worth it, especially considering the probabilities there involved. All right, well, that does it for me today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Also, go join our website at marketscholars.com for free. Like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.